Have you ever stared at a chart and wondered why it zigs just when you were sure it was gonna zag? Well, I'm here to tell you it is not random, not at all. There's a hidden logic, a kind of code that drives every single move. And in this explainer, we're gonna crack it together. You've probably heard this number before. It's the most brutal statistic in all of trading, 95%. That's how many traders consistently lose their money. But what if I told you that number isn't a warning? What if it's actually a roadmap?
This quote from Wade Goot really gets to the heart of what we're talking about today. The entire premise is this: to win, you don't need some secret indicator. You just need to understand why the vast majority loses and then have the discipline to do the exact opposite.
So let's just get this out there. The conventional wisdom, the stuff you read in old trading books, it's often a false narrative. The truth is, the market is a highly engineered environment. Price doesn't just wander around. It's moved with a very, very specific purpose in mind.
Okay, so here's our game plan. We're gonna break this all down into 5 clear steps. First, we'll talk about the market's hidden fuel. Then, we're gonna go hunting for liquidity pools. After that, we'll nail down the critical turning point. Then, we'll find our precise entry. And finally, we'll wrap it all up in a simple decision-making tool for you. Ready? Let's do it.
First up, we have to understand the why. Why does price move from point A to point B in the first place? If you don't get this, nothing else we talk about will make sense. This is the key that unlocks the whole thing.
And that hidden fuel, it's called liquidity. Now, don't get bogged down in some complex economic definition. For our purposes, it's really simple. Liquidity is just a giant cluster of stop-loss orders placed by everyday retail traders. It's the fuel, it's the target, it's the prey that the big institutions are always hunting for.
And you gotta remember this. In the market, money isn't just created out of thin air. It's transferred. For a massive bank to place a huge buy order, they need someone on the other side selling to them. They need a counterparty. So when your stop loss gets hit, that sell order you just placed, that's often them, on the other side, happily filling their giant buy orders.
So, if we know what they're hunting, the next logical question is, where do we find it? Where are these giant pools of money hiding right there in plain sight on our charts?
Now this requires a total shift in your mindset. From this moment on, before you even think about clicking that buy or sell button, you have to ask yourself this one question. Whose money am I trying to take? If you can't point to a clear pool of liquidity that the market is reaching for, then guess what? There is no trade.
And this money tends to pool in 2 very predictable places. Above obvious swing highs, you get what's called buy-side liquidity, or BSL. These are all the stop losses from the people who are shorting the market. And below obvious swing lows, you get sell-side liquidity, or SSL. Those are the stops from everyone who's buying. The big players hunt BSLs to help them sell, and they hunt SSL to help them buy. It really is that straightforward.
And when you look at a real chart, it's not even subtle. I mean, look at this. You see those clean, equal highs up there? That's a textbook pool of buy-side liquidity just sitting there. And down below, those equal lows? Yep, a giant pool of sell-side liquidity. This is exactly where the herd puts their stops. And it's precisely where the big institutions go shopping.
Okay, so the market has made its move. It raided a liquidity pool. The trap has been sprung. So how do we know the fake-out is over and the real move is about to kick off? Well, that brings us to the critical turning point.
We look for something very specific. It's called a market structure shift, or an MSS, and it unfolds in 3 clear steps. First, price runs up and takes out that liquidity pool. Step 2, it reverses, and usually it does so with some real force. And then step 3, this is the confirmation. It breaks the structure of the previous trend. So if it was going down, it'll suddenly push past the most recent little peak.
And this chart illustrates it perfectly. Just follow the price. See that series of lower highs? That's a clear downtrend. Then, boom, price sweeps the low, grabbing all that liquidity. It reverses hard, and then it breaks right above that last lower high. That break, that is your market structure shift. The game has just changed.
Look, I can't overstate how important this is. The market structure shift is your confirmation. It's the signal that the market engineering is done. The trap has been set and sprung, and now the real intended move, the delivery of price, is finally underway. Now here is a rule you cannot break. We do not chase that shift. Chasing is what the 95% do, right? Instead, we're going to be patient. We wait for the market to leave behind a very specific clue, a sort of calling card that gives us a high probability entry.
That signal starts with something called displacement. And this is not just any old price move. We're talking about a sudden, forceful, aggressive push in one direction. It's so strong that it's basically the institutions taking off their mask and showing their hand. They're not hiding anymore.
And on a chart, you can't miss it. It looks like this, a sequence of long, powerful candles all moving in the same direction. See how they have big bodies and tiny wicks? That's pure one-sided momentum. That right there is displacement. It's the engine behind the real move.
Now, when price moves that fast and that aggressively, it tends to leave behind a footprint, a little clue for us. It's called a fair value gap, or an FVG. It's literally a hole in the price action and inefficiency where only buyers or only sellers were participating. And you know what? The market has a memory. It almost always comes back to fill these gaps.
And this is where we take our shot. We don't buy the breakout with everybody else. We patiently wait for price to pull back and retest that fair value gap. That is our high probability entry. We tuck our stop loss safely on the other side of that manipulation low, and our goal is to ride the real institutional move that follows.
All right, we have covered a lot of ground, so let's put it all together. Let's synthesize everything we've talked about into a simple, step-by-step checklist you can use every single time you open your charts.
This is your decision matrix. Just 5 simple questions. Number 1, context. What's the bigger picture? Where has price been coming from? 2, liquidity. Where are the obvious stop losses sitting? 3, the raid. Has price already taken out that liquidity? 4, the shift. Have we seen a confirmed break in market structure? And finally, 5, the entry. Is there a clean, fair value gap to trade from? If you can't answer yes to all of these in order, you sit on your hands, no trade.
You know, when you start using this logical flow, something really powerful happens. It completely transforms your perspective. You stop being a reactive trader who just follows the herd off a cliff, and you become a patient strategist who actually anticipates and aligns with institutional order flow.
So really, it all comes down to this one simple question. In this engineered environment we call the market, there are only 2 roles you can play. And every single day, you have to decide which one you're going to be. Are you the hunter or are you the hunted?